Welcome to The Explainer. Today, we're jumping into a Nobel Prize-winning idea that, believe it or not, completely changed how we think about money, markets, and especially risk. It's a fantastic story about a question that seems so simple, but took an absolute stroke of genius to answer.
I mean, think about it. It's the most basic question any investor has to ask. How much more should I get paid for buying a risky stock compared to, say, a super safe government bond? Well, before the 1960s, the answer was basically just a shrug, a gut feeling. It was more art than science. But that all changed with a brilliant insight from a young economist named William Sharpe, who turned this whole thing into his science.
So to really get what Sharpe did, we first have to understand the puzzle that had investors totally stumped for decades. The real question was, what is the risk that you're even being paid to take on in the first place?
Back in the day, the thinking was pretty straightforward. You'd find a company you liked, one you thought was going to do well, and you'd buy its stock. Simple. The focus was all on that one single company. But this way of looking at things was missing a huge, crucial piece of the puzzle. It was kind of like trying to understand a whole orchestra by just listening to the violin play by itself.
Now, the first big crack in this old way of thinking came from another economist, Harry Markowitz. And what he did was brilliant. He didn't just give a new answer to the old question, he changed the question entirely.
This quote right here, it says it all. Markowitz argued that investors, smart investors anyway, don't just pick one stock. They build a collection of them, a portfolio, and suddenly that changed everything. The risk of your portfolio wasn't just about how risky each individual stock was, but about how they all moved together.
And this, of course, is where that old saying, "Don't put all your eggs in one basket," comes from. But what Markowitz did, and this is what's so cool, is he gave that common sense idea a really solid mathematical foundation. He actually proved that if you combine different assets that don't move in perfect sync, you can slash your overall risk without having to give up your expected return.
This whole idea led to a huge insight. Risk is not all the same. Markowitz's work basically split risk into two different buckets. Over here on the left, you've got idiosyncratic risk. That's the stuff that's specific to one company, like the CEO suddenly quits or a new product bombs. You can actually get rid of this noise just by diversifying. But then, on the right, you've got systematic risk. This is the big stuff, the risk tied to the entire economy that you just can't escape no matter how much you diversify.
So Markowitz set the stage perfectly. And along comes William Sharpe, who hears about these ideas and asks the next, much bigger question.
He basically said, okay, if everyone is out there trying to build these smart portfolios to get rid of that company's specific risk, what does that do to the price of every stock and bond in the entire market? He took Markowitz's idea about how one person should invest and scaled it up to a theory of everything.
Now, to make this work, he had to make a few simplifying assumptions. Think of it like building a model in a perfect laboratory. First, he assumed all investors are trying to get the most return for the least risk. Makes sense. Second, he imagined everyone agrees on what the future looks like for stocks. And third, that we can all borrow or lend money at the same interest rate. Now, yeah, it's a perfect world scenario, but it was designed to uncover a really deep, fundamental truth.
And this was the huge Nobel Prize-winning breakthrough. The conclusion was just stunningly simple. In a market full of smart, diversified investors, you don't get paid extra for taking on that company-specific risk. I mean, why would you? You could have gotten rid of it for free just by diversifying. The only risk the market actually pays you to take is the one you can't get rid of, that big systematic risk, the risk of the market itself.
Sharpe then managed to boil this incredibly powerful idea down into one of the most famous equations in all of finance. It's called the capital asset pricing model, or just CAPM for short.
Okay, I see the equation, and I know what you're thinking. But don't let the math scare you off. What this says is actually really straightforward. The return you should expect to get from any stock is simply the risk-free rate, what you'd get from a super safe government bond, plus a bonus for taking on risk. And that entire bonus, it's decided by just one single thing.
And that one thing is beta. Beta is the magic number here. It doesn't measure the total risk of a stock, not at all. It only measures its systematic risk. Basically, how much that stock tends to dance along with the overall market. According to CAPM, that's the only kind of risk that you get paid for.
So here's how it works. A stock with a beta of exactly 1 just moves right along with the market. A stock with a high beta, like maybe 1.5, is more volatile. It jumps higher when the market goes up and falls harder when it goes down, so it should give you a higher return. And a low beta stock is more stable, so you should expect a lower return.
And this leads to the model's biggest prediction. If you were to plot out the expected return against the beta for every single asset out there, they should all fall neatly on a straight line. We call it the security market line. More beta equals more expected return. It was this clean, powerful, and, most importantly, testable prediction about how the whole financial world ought to work.
And look, this wasn't just some dusty academic theory. Sharpe's idea literally became the backbone of modern finance, and its impact on the real world was, and still is, absolutely massive.
You can see the whole journey here. It starts with Markowitz in the 50s, then Sharpe builds on it with his model in 1964, and it all culminates in that Nobel Prize in 1990. That prize really cemented just how foundational these ideas were.
Seriously, the model's influence was everywhere. It totally redefined what risk even meant. It created a benchmark so you could finally tell if your fund manager was actually any good or just getting lucky. It gave huge corporations a tool to figure out their cost of capital for massive projects. It really did turn asset pricing into a real science.
But of course, no model is perfect. The real world is a messy place. And as more and more researchers crunched the numbers, they started finding these little patterns, these anomalies, that the clean, simple CAPM just couldn't explain.
Yeah, the cracks started to show. Researchers found that, for some reason, smaller companies and these value stocks consistently earned higher returns than the model said they should. Other things, like momentum, also seemed to predict returns. And then people like Robert Shiller came along and showed that markets are just way more volatile than the model would suggest, which kind of hints that maybe we investors aren't always the perfectly rational calculators the theory assumes we are.
And that really brings us to the big question today. William Sharpe gave us this beautiful, elegant tool, a theory of how a perfectly rational market should behave. Now, have we spent the last few decades finding all the ways the market isn't perfectly rational? Absolutely. We now know that psychology and all sorts of real-world frictions play a huge part. But even so, CAPM is still the benchmark. It's the foundational idea that every other theory has to either build upon or argue against. And that right there is the testament to its enduring power. It was the first and most important answer to finance's biggest puzzle.